Hello and welcome to the ESGA Global Lecture Series. My name is Amir Amel-Zadeh. I'm an Associate Professor of Accounting at Saïd Business School, University of Oxford. First of all, I would like to thank Professor Yong-Sikok and Professor Jae-Hyuk Lee for inviting me to speak on this lecture series. It is a great pleasure, even if we don't have the opportunity to meet in person. The title of my talk is Sustainability and Capital Markets. Do investors care about ESG? This talk is based on several of my research projects, some of which have been published, some are still working papers, and I rely heavily on work with my brilliant colleagues at other institutions. In this line of research, I'm largely interested in whether, why, and how investors consider sustainability information for investment purposes. To investigate these questions, we have compiled field evidence from a large global survey with institutional investors and examine investment portfolio holdings and the trading behavior of individuals. Now, the aim of my talk is to provide you with summary evidence from our research, what we know about investor attitudes towards sustainability and their motivations, and secondly, to highlight the implications for corporate issues, and also to make some suggestions for future research in areas in this field that I believe have still remained unanswered. Now, in the recent past, particularly after the financial crisis of 2008, we have seen an increase in investments that follow sustainable investment criteria, or ESG. And in addition, anecdotal evidence suggests that more and more investors, particularly large asset managers, are becoming more vocal in demanding from their investee companies that they take into account of sustainability and in their corporate decision making, whether it's in their policies on climate change, on political donations, or on their employee practices, data privacies, and so on. And despite a large interdisciplinary body of research that examines sustainability-related topics, spanning finance, economics, management, and many other adjacent fields, we still lack a deeper understanding why and how investors use ESG information, and whether this trend that we are witnessing at the moment is just a fad or actually impacting asset allocations in an economically meaningful way. Now, anecdotal evidence suggests that it does. For example, the PRI reports that asset managers and asset owners have more than 100 trillion US dollars assets under management, have committed to incorporating ESG considerations in their investment processes and decisions. Now, before I start showing some empirical evidence, let me first ensure that we are all on the same page with respect to an understanding of sustainable investing. This is a broad area and with heterogeneous players in a variety of definitions. And this is my take on it. So to the left of the graph, you have ESG investing, which I consider as conventional investing, but with additional peer non-financial information taken into account. So ESG information. This can take the form of screening, integration, or engagement strategies. Now, the primary objective here is still to maximize financial return. On the other end of the spectrum, to the right, we have impact investors that primarily invest for a social or environmental goal alongside a financial return. But generally, the primary goal is the social return. And in the middle, we have this category that I call norms-based investors, or what previously was known as SRI, where investors base their investment decisions on their values, norms, or often religious considerations. Now, these could be church endowments, for example. Now, these investors often use exclusion strategies, so exclude certain sectors from their portfolios or engage with firms. Here, the investors are sometimes happy to forego financial returns if the source of these returns is not compatible with their norms or values. So how big is this market in each of these areas? This slide shows the market size of the sustainable finance market by the end of 2020, for which I've combined data from the IFC, McKinsey, GIM, so the Global Impact Investing Network, and the PRIs, the Principles of Responsible Investment. with my own estimates. Of the total financial assets of 350 trillion, roughly a third are under management by PRI signature. So now this includes all of the assets under management of those signatories, and not only those that are managed with some form of ESG investment strategy. So if we only focus on ESG investment strategies, we again have roughly a third of total AUM of those PRI signatories, or about 30 trillion. Still a sizable amount, which includes investment strategies that involve screening based on ESG ratings, exclusions, or some form of engagement with investee companies. Now, these include financially and impact or socially motivated investments. Of those, about 3 trillion are so-called impact-aligned investments, such as green bonds or social or sustainability-linked loans, where a social or environmental impact is measured directly. Now, this includes a smaller, still niche, but rapidly growing market of impact investing, which mainly focuses on private market equity and debt investments, with emphasis on social or environmental outcomes. Now, what do we know about investor attitudes with respect to ESG? Now, the existing, mostly empirical archival literature already provides with some insights, suggesting that institutional investors consider in their investment portfolios increasingly sustainability characteristics. Now, they're increasingly tilted towards more sustainable firms, and that they're also increasingly engaged with these firms on sustainability issues, and particularly climate change is one of those that are main risks that investors are concerned about. Now, we so far have less evidence on sustainability attitudes and behaviors of retail investors, and I'll show you some but the most compelling comes from some studies on mutual fund flows that show that large retail investment flows with respect to sustainability scores, so high scoring funds in mutual funds. Now, against this backdrop, let me first go over the field evidence on institutional investors before going on to providing the evidence on the wealthy private investors. Now, with the help of BNY Mellon, we ran a survey capturing the views of almost 500 mostly mainstream asset managers and asset owners from around the globe, with the majority coming from North America and Europe and also Asia. We capture around 40% of AUM globally, so a fairly large size of fraction of investors globally. Now, in the first instance, we were interested in understanding the motives, and what motivates investors to use ESG information, and whether they do so at all. So the table here provides the percentages of the respective responses to this question. The large majority here responded that they do take ESG information into account, and predominantly so because they believe sustainability information to be material for investment performance. Now, this is interesting given that the academic evidence has been rather mixed at this point. We also found some interesting regional differences, with more European investors than US considering financial motives, but also ethical motives as the driver for ESG integration. Although not shown here, investors in Asia actually exhibit similar responses to the European investors. Now, part of the higher ethical motivation we can trace back to the existence of more religious endowments among European asset owners, for example, for whom ethical norms play an equally large, or if not more important role as financial motives. The data also suggests that US investors are significantly more skeptical with regards to the financial materiality of ESG information, and consequently fewer US investors than Europeans use it. But also that there is a consensus that the data is just not reliable enough for investment purposes. In additional results that I haven't tabulated here, particularly the lack of standardization and comparability seems to inhibit investors to integrate ESG information. Something that the accounting standard setters and European regulators, as you might know, are currently looking into. Now, when trying to understand the financial materiality further, we find, not surprisingly, that not all ESG information is equally material to all sectors. So now this figure or table shows the percentage of the responses to which ESG item on the left respondents found to be material for which sector shown in the columns. So the response rates here are color-coded with lighter colors representing higher response rates by investors, viewing the particular ESG issue as financially material for the particular sector in the column. Now, one key takeaway here for companies is that employee policies and governance policies or governance factors overall are material irrespective of the sector. But that the E and the S factors vary largely across different sectors, but in meaningful ways. So for example, for investors, environmental issues seem to be more important for resource-intensive sectors such as energy and materials, but social factors such as the impact of products or data privacy are more important for knowledge-intensive sectors. This lines up with anecdotal evidence and more recent news evidence of events in the energy and social media sectors. But let's have a closer look at this. When we ask investors to rank the most pressing ESG issues for the medium and long term, the following table presents them. Now on the left are the top 10 issues as highlighted by asset managers, and the right shows the top 10 list for asset owners. Again, both investors groups seem to emphasize the importance of strong board policies, so governance and codes of conduct. In some of the verbal comments received, these were seen as fundamental to enabling better performance on other ESG issues, such as energy management, data security, or waste management, which are the next ones following down the list here. So there's relatively large overlap here between ESG issues that are considered financially material or important by asset managers and asset owners. But again, governance is important. Now on the next slide here, it's then interesting to understand what investors believe how these ESG issues affect shareholder value. For this, for comparison, we also asked several hundred global corporations what their views are. Now, the graph on this slide shows the results. I would just like to direct your attention to the right and left tails of this graph, as they show the largest discrepancy in responses between issuers and investors. There's a relative consensus that ESG issues affect a company's brand and reputation. But while issuers highlight their role in reflecting business strategy and leadership quality, investors consider ESG issues as a lens on litigation and regulatory risk, as well as risk of activism against the company. So this is regulatory activism or activism of consumers or even shareholders. So at least among our respondents, relatively more investors view ESG primarily as risk factors compared to issuers that are more focused on the opportunities here. Now, how do investors use sustainability information then? Consistent with the anecdotal evidence I mentioned earlier, they largely seem to engage with their investee companies, integrate the information into their valuation models, or use it to screen firms for portfolio construction. Now, it's interesting here to note that European investors are more likely to engage with the firms, while US investors are more likely to use negative screening. Now, this might also explain, as I showed you earlier, the higher skepticism among US investors towards financial materiality of ESG, as exclusion strategies have been shown to likely have a negative or at best neutral effect on financial risk and returns. In Europe, more investors are also using thematic investments, which are green bonds or investment vehicles that are dedicated to specific themes, such as water. The next graph, somewhat more complicated, summarizes responses to two Likert scale questions. So on a scale from 1 to 5, on which strategy investors believe to become more important in the future. So this is on the vertical axis here. And what impact on returns they are expecting. So this is on the horizontal axis. So both show, the further top you go, or the further to the right, show the higher on the scale, so the more important or the higher the impact on returns. The top right-hand corner of this graph shows the strategies that are viewed by investors as becoming more important and also being most beneficial to investment returns. So these are engagement, integration, and screening strategies. So these are the top 3 strategies also from the previous slide, and are also expected to become more important in the future. Except for negative screening here, which is essentially portfolio exclusion, which is also expected to have a relatively negative impact on returns compared to other strategies. In other words, investors will likely screen out ESG underperforming issues, further highlighting the importance of ESG ratings, as well as engage more with issuers, both of which can be quite challenging for issuers. Now let me move on to the evidence we have on private wealth investors. For this project, we were lucky to gain access to proprietary data of investment holdings of private wealth investors and one of the largest European private banks, with more than 100,000 clients and about 200 billion in assets under management. The data has some interesting features that will allow us to draw more robust causal inferences. So specifically, through a change in the ESG ratings provider that this bank essentially took on halfway through our sample period, where we were able to look at ESG ratings for a wider universe of assets that were now reported using this new ESG ratings provider compared to prior to this ratings provider change. Now, so what this means is that for assets that previously did not have their sustainability characteristics reported to these private investor clients, these features now became more saliently available to the investors in reports, allowing us to assess how these investors react to these now newly visible ratings in their asset allocations. So we're also able to exploit variations by client type, because some investors, the advisory clients of this bank, were shown ESG ratings, where some others, execution-only investors who use the bank only as an execution platform, were not shown sustainability ratings. And also variation across country, where in some countries these ratings were shown, and in some other European countries these ratings were not shown. So it's always nice to have research findings you can summarize on one slide, or essentially on 2 graphs here. And this is it. So the left graph shows cumulative access flows over our sample period from January 2017 to December 2019, where the graph shows consistent inflows in excess of normal flows into assets with the highest ESG rating, and excess outflows from assets with the lowest ESG rating. So these differences here are economically large, and they're roughly above 3 billion over our sample period of these 2 years. So quite economically impactful. Now, on the right-hand side, the right-hand side graph also shows cumulative flows, excess flows, over and above what one have expected investment flows to be into these assets given their financial performance, and after ESG ratings changes. So here the top line shows cumulative flows into assets with ESG ratings upgrades, and the bottom line shows those with ESG ratings downgrades. So the graph essentially shows that changes in ratings, particularly upgrades here, matter, and are followed by increases in inflows for those assets. Now, specifically, our results here, though, show that ESG ratings have a significant impact on investment allocations by private wealth investors. So to summarize, in our sample, these equate to about 75 million euros per month in incremental flows. So this is economically large given the size of these portfolios of the investors in our sample. Now, on this slide, I just summarize the estimation techniques or methods that we use, essentially that are summarized in the graphs that I previously showed you. So I skipped the technical details here, but these are just for your information to show you how we run the estimations. But perhaps to just highlight the main results, let me show you the results of the quasi experiment that I just touched on before, that we were able to exploit in our sample, where this experiment consisted of the fact that for some assets, more or less randomly, because of the change in the ESG ratings provider, the ESG ratings became now available, whereas for other assets, ESG ratings had always been reported by the bank to their clients. So we can measure how these, and now for these new assets for which the ESG ratings become available, and what the effect of the ESG ratings are on investment flows. So we are more confidently able to measure causal effects of ESG ratings on investment flows, which is quite challenging in empirical studies. Now we use this to test in a triple difference regression whether investments into these assets with newly reported ratings changed compared to assets that always had their ratings reported. So that's the first difference. After the ratings change, right, so that's the second difference. And if these assets had the highest ESG rating compared to those with the lowest ESG rating. So that's the third difference, hence a triple difference estimation. So this triple difference design allows us to measure the incremental causal effect of having a high ESG rating for companies within the same industry, holding fixed all other financial and liquidity characteristics. So what does the table show? So the table shows on, in the first column, the overall results, where there's an almost 2% incremental growth in monthly investment flows into assets with the highest ESG rating. This is per month on average. This effect also only exists for those investors that actually receive those ESG ratings or see those sustainability ratings as they are shown by the bank's advisors to those clients. So these are the advisory clients in the middle column. And it's not an effect that is visible for clients that do not receive reports with those sustainability ratings. So this gives us even more confidence that it's the sustainability ratings that impact or causally affect those investment flows and not other coinciding economic or sector factors. So the results here from this quasi-natural experiment confirm that after ratings become visible to investors, flows into these assets with the highest ratings are higher than those into assets with the lowest rating, even after controlling for all the differences of flows within the control group across the same ratings category that always had their ESG rating. Important. That's important. Now, let me now show you the tests on ESG ratings changes, and where we examine the reactions to these ratings changes as shown in the graph before. So this table here shows the cumulative effect of the cumulative axis abnormal flows, investment flows in excess of what would have been expected given our benchmark estimation of normal flows into these assets, given their financial performance during the period without the ratings change. So again, we find that investors, particularly in the advisory group, that get these ESG ratings reported react to ratings upgrades with increases in investment flows over the subsequent 6 months. So that's what the table shows. We do not find any reaction to downwards, but here we are only examining one-notch upgrades or downgrades. So we do find significant outflows, which I haven't reported here, for larger or more extreme ESG rating downgrades. So in other words, investors are sensitive to ESG controversies. In an extension to our study that we're currently working on, which is still a kind of work in progress, but I'm happy to show you some initial results here, we further look at the impact of COVID-19. And here the question really is whether investors care about ESG because of financial motives or due to some other non-pecuniary social motives, or both. In other words, do investors still consider ESG information when the assets underperform financially? And the COVID-19 shock here gave us an opportunity to test this. Now, let me show you how. So this graph again shows you cumulative flows, this time on a weekly basis, for this sample of private and wealth investors that we had, but here during 2020. You can see how at the height of the COVID market shock here, so between February and kind of end March 2020, in between the red vertical lines, affected investment flows. And the solid black line here are investment flows into assets with high ESG ratings, and the dotted line shows the flows into assets with low ESG ratings. You can see how the COVID crisis only accelerated the shift into more sustainable assets. It's quite stark discrepancy. Now, this table here on the next slide also shows you in a little bit more in detail the differences in between assets that had a low return, the lowest return. So these are quintile portfolios, the lowest return during the COVID crisis compared to the highest return. So we want to understand here whether drawdowns affected how investors invested in assets with particular bad financial performance. Now here you can see on the left-hand side in this coefficient with high ESG post-COVID that is still positive and significant, and also economically significant and larger than for those assets on the right-hand side column, meaning that it's still irrespective of the financial performance of these assets, investors actually considered sustainability information in their investment flows, in their asset allocations, and this is shown in their investment flows. Okay, so what does this tell us? Let me show you on the next slide. Let me actually skip the next slide and come to some conclusions here. So what does this tell us? So to me, this says, one, that investors generally and institutional investors in particular, but also individual private wealth investors, seem to care about sustainability ratings. At least from our evidence on sustainability on institutional investors here, we also know that they care for different reasons and incorporate ESG information in different ways. So now the evidence tells us that not all ESG information is equally important for investment decisions. And this importance or materiality in accounting speak likely varies across countries, sectors, and even firms within the same sector. Now, this in turn likely has implications for the reporting of and demand for ESG information. We also find strong evidence that retail or private wealth investors consider ESG ratings, particularly if they are made aware of these ratings by their financial advisors. What does this mean for issuers? Now, I think one important takeaway for issuers is to know their investor base and to tailor ESG disclosures to that investor base. Investors' information needs differ depending on their motivations, why they consider ESG information, and whether it's for ethical or financial motives. So in contrast to financial disclosures, one size does not fit all with ESG disclosures. One complication, of course, is then to distinguish between financially material ESG information and other ESG information that might be important to other stakeholders. particularly with respect to achieving the Sustainable Development Goals. Now, second, the evidence then suggests that in the absence of standardized and comparable information, investors turn to ESG ratings providers. The ratings seem to have a significant influence on investment allocations, despite the questions about what these ratings actually measure. And third, corporate governance matters and is seen as a foundation for good ESG performance. In other words, corporate governance might work as a moderator for ESG performance and how investors perceive other ESG factors and initiatives that the company is engaged in. And finally, we find that investors are increasingly turned to engaging with their investee companies and view this strategy as beneficial to their returns, something that colleagues confirm in empirical research as well. So this brings me to areas which I believe are still open for further research, which might be interesting to the researchers in the audience here. First, it is likely that ESG factors that are financially material don't necessarily overlap with those that are important from a societal standpoint. The question then is that if financial materiality is the primary motive to invest according to sustainable principle, whether that leads to allocation of funds in areas that are not the most desirable or the most pressing. So far, we don't really know much about the consequences of the financialization of sustainable development. Second, if ESG ratings have such a large economic effect on asset allocations as we find, do these allocations lead to mispricing? That is, are these efficient given the limited supply of sustainable assets? So imagine a best-in-class or relative ESG strategy that only invests in the top quintile, top 20% of the highest sustainability assets with the highest sustainability rating, which generally is also how the ratings provider rate assets. So one only needs to look at the current valuations, for example, of recycling companies to find anecdotal evidence of the hotness of sustainability. And again, the equilibrium asset pricing effects are just being investigated now by researchers. Third, despite the numerous efforts, at least in my view, the evidence on financial returns to sustainability is still somewhat inconclusive. This might have to do with the fact that prior research conflates and averages the different investment motivations and strategies, and they naturally have different impact on returns, as I also showed. So there's also still not much direct firm or even better operating level evidence on operating performance effects. I'm thinking here of, for example, eco-efficiency, productivity increases, reputation, brand effects, and others that we're still lacking evidence for. And lastly, it is somewhat concerning to find that large amounts of investments follow sustainability ratings or ESG ratings that are based on information that is not standardized or audited. So the question this raises is whether these ratings agencies, and hence the investment flows that follow their ratings, are to some extent duped or fooled by greenwashing or influenced by it. And detecting greenwashing is difficult, not to mention whether it has a causal effect on ratings or allocations. But I hope that clever researchers in the audience here might find ingenious ways to disentangling these effects. So, in conclusion, there's still much to research on the role of sustainability in capital markets and its effects. But I hope that some of my research here that I presented to you is helpful to issuers in being more effective in communicating their sustainability transition to investors, and provides researchers with some helpful pointers about where to look for still unanswered questions that we urgently need answers to in this field. So I hope this talk was informative, and I look forward to engaging with you in one way or the other, if in terms of if you have questions or suggestions, my email is on the slides, and I hope to be in contact with you. So thank you very much for your attention, and good luck, and all the best. Thank you.